Hello, everyone, and welcome to Financial Accounting. Today, we will continue studying accounting for merchandising operations. We will learn about net sales, cost of goods sold, and gross profit, and compare the income statements of service and merchandising companies. We will also look at the single-step and multiple-step income statements and learn how the cost of goods sold is calculated and reported under a periodic inventory system. And finally, we will take a look at the statement of retained earnings, the balance sheet, and the statement of cash flows of a merchandising company. The business activities of a service organization involve providing services to customers and earning fees for those services. In contrast, the business activities of a merchandising organization involve buying and selling merchandise. A merchandising company purchases goods to be sold to customers. When the merchandise is sold, the revenue is reported as sales, and its cost is recognized as expense. This expense is called the cost of merchandise or the cost of goods sold. The term net sales means revenue less returns and discounts. The term cost of goods sold or COGS means the cost paid for the merchandise. The difference between net sales and the cost of goods sold is called gross profit. Let's look at how merchandising businesses report the results of operations. The cost of merchandise sold is subtracted from sales to arrive at gross profit. Note that the service business income statement will not have a cost of goods sold and gross profit. Now, let's look at the multiple-step income statement of a merchandising company. A multiple-step income statement contains several sections, subsections, and subtotals. The revenue section is expanded to include sales, sales returns and allowances, sales discounts, and net sales. Let's look at the multiple-step income statement of Delta Corporation, a merchandising company. Net sales of Delta Corporation are determined by subtracting sales returns and allowances and sales discounts from sales. A multiple-step income statement makes it easier for a stakeholder to analyze the operations of an organization. The gross profit subtotal represents the difference between sales revenue generated from selling products and the cost of those products. Operating expenses, or OPEX, refers to the cost incurred by a business for its operational activities. In other words, operating expenses are the costs a company must make to perform its operational activities. Operating expenses include selling and administrative expenses. Operating income measures the corporation's results from its total operations and takes into account the selling and administrative expenses. The next section includes other income and expenses. Other income and expenses represent income from sources other than the normal operations of the company. Net income is the final measurement of the corporation's performance. Not only does net income measure the profit or loss from business operations, but it also measures the impact of any other secondary income activities or expenses. There are two inventory systems, Perpetual and Periodic. Delta Corporation is using a Perpetual inventory system. Under a Perpetual inventory system, each purchase and sale of merchandise is recorded in the inventory and cost of merchandise sold accounts. In this video, we will briefly review the cost of merchandise sold under a periodic inventory system. If you want to learn more about the Perpetual and Periodic inventory systems, please watch the video Accounting for Merchandising Activities. I'm posting the link here and in the description box. If a company uses a periodic inventory system, the calculation of the cost of merchandise sold may be a bit more complex. The inventory balance at the beginning of an accounting period is the starting point for the calculation of the cost of merchandise sold. Purchases of inventory are added to the beginning inventory balance. These purchases are adjusted by any necessary purchase returns, allowances, or discounts. Any freight paid to acquire the inventory is added to the net purchases to arrive at the cost of merchandise purchased. Account evaluation is made of inventory at the end of the accounting period, and that amount is subtracted from the cost of merchandise purchased in order to arrive at the cost of merchandise sold. A single-step income statement deducts the total of all expenses in one step from the total of all revenues. This emphasizes the total revenues and the total expenses of a company in determining net income. The retained earnings statement is prepared for a merchandising business in the same manner as for a service business. The balance sheet of a merchandising organization will include the account merchandise inventory in the current assets section. This amount represents the value of any products that remain unsold at the end of the accounting period. On the statement of cash flows, the positive cash flow from operating activities is used to fund cash paid for the purchase of equipment under investing activities and to shareholders as dividends, and to creditors to pay off notes payable. Note that changes in merchandise inventory are reported in the operating activities section. You can find more videos about accounting for merchandising activities in the playlist for Chapter 6. The link is posted here and in the description box. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.